folks, Greg Prato here, Prato Capital Management in White Plains, New York. And today we have with us Apollo Lopescu from Dimensional Fund Advisors, one of the national and global premier investment advisory companies in the world, managing over 650 billion with a B in assets. And we have Apollo back because he's come to our offices in New York and got such great reviews and really was dubbed the master of explaining things, should we say. So again, inflation's on everybody's mind. You know, recently it's popped up. It's going to go through the moon. Everything is going to cost us our last penny in our pocket. But with inflation so much in the news and in investors' minds, how do you suggest investors approach this topic?
Yeah, and it's so interesting because when you look at inflation, it is something that it's presented in the media as sort of the boogeyman that's there to get you. And for sure, if you are a consumer, inflation is not a good thing, because inflation basically means prices are going up. So when prices going up, the same amount of money will not allow us to purchase the same thing. So we can purchase less. So we lose purchasing power in a technical jargon. So inflation is really not good for consumers. And that's why a lot of us dislike inflation. What's interesting, though, is that inflation has been part of our economy for many, many years. And in fact, it's not only that it's been part of it, but it's somehow necessary for the economy to function properly. Because if you think of a consumer, certainly not a good thing for us, prices going up. But if you're a business, let's say you're a farmer and you took out a loan and you have to repay it with interest, well, in order to repay the loan and interest, you actually need to generate a little bit more revenue the following year. So if your prices don't grow, you're stuck with the revenue that you had. It's going to make it harder for the businesses to expand. So in that respect, a certain level of inflation is somehow almost beneficial to the economy. And in the long run, Greg, the inflation rate, the price growth in the U.S. from year to year has been an average of about 3%, meaning that if I bought a pair of speakers for my computer last year for $100, this year it would cost me about $103. So it's not unusual, it's not unprecedented. As I said, to some degree, it's desirable. Even the Fed has put a target of about 2% on the inflation for the economy. So just to set the stage, just the word inflation itself, it doesn't have to be that scary. It's been with us, and to some degree, it is necessary. But the numbers that you're hearing right now are not 2 or 3%. They're closer to 7, 8%. And a lot of folks are saying, wait a second, if prices continue to grow at this rate, we're going to be in big trouble. As you said, we're going to spend a lot more money and we're going to be able to buy a lot less. So if you think of this period that we are in right now and what to think about, what to expect from it as a consumer, I'd say that what's interesting is that there are two theories, two narratives, two scenarios that are being put out there by economists and investors for that matter. And one of them is that we're in a transitional phase, that we had this pandemic type of economy, and this pandemic has led to things being harder to make. And then as we transition out of it, we might see a spike in prices, but there's no reason to believe that global economy won't be able to resume producing the way it did, and then the prices are going to flatten out soon enough. And that's the first scenario of a transitional type of price spike, and then we're going to see a flattening. The second scenario is a little more ominous. It's saying not so fast. Consumers are getting used to paying more. Companies are getting used to passing those increases. So as a behavior, from a human perspective, this is not necessarily great, but also, workers are going to demand higher wages. And then when higher wages come around, then prices have to grow to keep up with those. And you have something called a price wage spiral, which is going to lead for inflation to last longer at a higher level. And the issue there is that if inflation stays high and the Federal Reserve tries to do something to reduce it, like it was the case in the 70s and early 80s, then you're going to have perhaps a recession, some economic pain. So those are the two scenarios. And frankly, Greg, as of this date in late March, neither the Fed chairman nor the president of the country, not myself, nor you, nobody in the world knows exactly which one of these scenarios will play out. So it's important to acknowledge them, but also don't listen to any one opinion because it's just an opinion. What I rely on more is the market. We are very big believers in markets. And the market right now has a very powerful signal about what to expect on inflation, let's say over the next 5 or 10 years. And it's not a forecast. It's not an opinion. Greg, it's something that I think of as a referendum. That every single day in the market, investors are basically voting in this referendum with billions and billions and billions of real dollars. And the way they vote is in the way that they price, in the way that they're paying for different types of financial instruments, in particular bonds, some that are kind of hedged to inflation and some that are not. And the difference in price is the clear market signal on the expectation of inflation, let's say over the next 5 years. And that metric is actually being, it's well known among investors. It's actually being watched by the Fed as well. And in fact, I'm going to share with you the live website from the Federal Reserve looking at this metric called the break-even inflation rate. And this is for the 5-year time frame. And just because it's not a household name, Greg, let's just make sure that we know exactly what it is. This value implies what market participants expect inflation to be in the next 5 years on average. So this is, again, it's a market signal. It's a very powerful market signal onto what should we expect over the next 5 years. And if you look back a little bit, what you see is that over the past 5 years, we have had unusually low inflation to the point we barely reached the target that the Fed had set. So it was well below the Fed's target. And when the pandemic hit, we had the opposite concern. Boy, prices are not going to grow. So we really had a different issue just a couple of years ago, exactly 2 years ago. But as the economy reopened, the stimulus kicked in, economy kind of got back on track. The expected inflation over the next 5 years is in the neighborhood of about 3.6%. So what's interesting about this number is that it's higher for certain than we've had over the past 5 years, because the past 5 years have been a bit of an anomaly, way below almost half the historical rate, the historical average, and even below the Fed's own target. So where we are today, it's higher than the previous 5 years, but it doesn't, the market, at least right now, the market signal is that we don't expect that this level of inflation that we have right now to sustain over the next few years. It's just going to be lower. It's a little bit above the historical average, but it's going to be lower than what we see right now. And what's also interesting, Greg, is that this particular referendum takes place every single day. And if you look on a finer, on a smaller time scale, let's say you take the last year, what's fascinating is to see that as information comes in, the expectation of inflation goes up. It went from 2.4 to 2.7, but then it dropped again as information came about supply chains and shipping. And it was the same in the fall. It went from about 2.4 over 3, but then instead of climbing, it just kept dropping and dropping as information came out that is incorporated in this signal. And the last thing that I'll mention about this break-even inflation rate is the day before the invasion. This is the day before the invasion of Ukraine, before the war started. The expected inflation was pretty much spot on the long-term average. And what it appears to be the case is that now that we're about a month into this war is basically costing us as consumers about 0.5% more per year over the next 5 years, assuming that things stay the same. I mean, not assuming, but this is based on the information we have today. As information changes, certainly we're going to see this number adjusting. But as of now, as I said, if you're an investor, if you are a consumer, you're likely going to see prices higher than over the rate of increases in prices higher than over the past 5 years, but it's gonna taper down, at least based on the current market signal.
Well, listen, thanks for being with us today, and Apollo, thank you for your time. Always great to see you. I really appreciate it. Until next time.
Thanks for having me.
Feel free to follow us on social media. We're on Twitter, we're on Facebook, we are on Instagram, and we are on LinkedIn. And as always, you can come to our website at pradocapital.com. Have a great day.